It's my view that gold is the better strategic tier one asset. And no, I don't think gold only goes up, but the world is saving in gold for a reason. Central banks are stacking it for a reason. The COMEX is out of gold for a reason. Central banks have been selling treasuries net and buying gold for a reason. All these signs are here that gold is the new tier one asset. So in times of crisis, it will be a better safe haven. Retail investors are not buying. It's still less than 0.5% of financial allocations. Family offices, less than 1%. It's the big whales that are buying gold. The retail investors, even the smart quote unquote family offices, are still in their diversification model. They're still led by CIOs that come from the banking system, still think like the old way. If gold's only a 0.5% allocation and we get to a 40-year mean of 2%, that's a 4x demand increase. A 4x demand increase will increase the price.
Gold prices stabilized on Friday after retreating from their record high of $3,358 as investors captured profits over the extended Easter weekend. Despite this pullback, market conditions appear increasingly favorable for the precious metal's continued strength. According to macro strategist Matthew Piepenburg, the landscape of central bank gold acquisition has dramatically transformed in recent years. While central banks have consistently maintained their status as net buyers of gold for over a decade, the scale of these purchases has increased exponentially since 2022, reflecting profound shifts in global monetary strategy. From 2010 to 2021, central banks worldwide maintained a steady but modest pace of gold accumulation, purchasing an average of 118 tons annually. This consistent acquisition provided an essential stabilizing element during economic turbulence, including the aftermath of the global financial crisis and the economic disruptions caused by the COVID-19 pandemic. However, a dramatic shift occurred in 2022, when central bank gold purchases more than doubled to an average of 291 tons annually, nearly 3 times their previous long-term average. This remarkable acceleration represents one of the most significant changes in international reserve management in decades and signals growing concerns about traditional reserve currencies. Piepenburg notes that this surge in central bank gold demand coincides with several critical developments in the global economic landscape. The expansion of the BRICS Plus coalition, which includes major gold producers and consumers, has increased interest in gold as an alternative to dollar-denominated assets. The timing of this dramatic increase in gold purchases also aligns with renewed uncertainty regarding inflation trajectories and interest rate policies across major economies. As central banks navigate complex monetary challenges, gold's historical role as a store of value appears to be gaining renewed appreciation among institutional decision-makers responsible for national reserves. Before diving in, subscribe to our channel and click the bell icon to get notifications for our latest content, market insights, and expert analysis. Stay informed and never miss an update.
Before 2022, although the central banks were net buying gold over treasuries, central banks were buying about 118 tons a year of physical gold. Fast forward to today, after 2022, the average is about 290 tons. So I'm not making this up. The central banks are the buyers. And since 2022, and since we weaponized the world reserve currency, and since we made these policy changes, not only is central banks buying at 3x their prior levels, the COMEX is running out of gold to keep churning and burning. They're standing for delivery. Gold and silver are leaving those markets. I'm not making this up. That's not a gold bug case. And also since 2022, the BIS, of which I'm absolutely no fan, made gold a tier one asset. And in 2020, at the height of the COVID crisis, even before we weaponized the dollar, the IMF and Christina Georgieva was already talking about gold as part of the central bank new digital currency. So the world, the big money, the big whales have been seeing the distrust of this dollar and have been seeing the replacement of the US Treasury with physical gold as a tier one strategic reserve asset. That does not mean the world's going to have a gold backed currency. What it means is because of the massive, irrational debt crisis, liquidity crisis in the the US Treasury is no longer the savings asset or the safe haven of last resort that it was years ago. It is now physical gold. That is empirically obvious based on the flows and the data and the stacking going on. Why? Because sovereign countries don't trust America or the dollar, the treasury they used to. They'd rather save in gold, which is a true store of value, unlike the US Treasury, and then spend in fiat. And even the BRICS last year in 2024, when they met in Kazan, they're basically making their BRICS trade settlement currency 40% backed by gold and then local currencies intermixed. Even the IMF is talking about gold for the new CBDC. The simple truth is IOUs from Uncle Sam aren't what they used to be because we're in a liquidity crisis, because we're in a debt crisis. There's got to be a new change to sounder money. It doesn't mean the end of the dollar. It doesn't mean the end of world reserve currency status. But to answer your question, yeah, sovereigns, central banks, and nations, and the BRICS, and the East, and 45 other nations would rather store their money or their value or hold their value in a strategic reserve in gold than the traditional US Treasury, which is devastating By 2008, on our great financial crisis, China saw the writing on the wall. Bernanke's QE to the moon was going to really discredit the dollar. By 2014, central banks around the world were dumping US Treasuries net and stacking gold. By 2022, we weaponized the world reserve currency. The BRICS got more and more ignited. And then we had 45 countries trading outside the dollar, 30 repatriating their gold. Oil was retraded outside of the petrodollar. The BIS a year later in 2023 made gold a tier one asset next to the US Treasury. And so in 2025, we're seeing the COMEX pushing gold out the door because countries would rather store gold than churn and burn on the COMEX. Again, all of these symbols since 1971 were indications of the dollar being discredited, being distrusted, being less loved because of our debt. To say this is a Besant Soros-like moment. It isn't. What's happening today, again, the dollar is falling. The dollar is less trusted. The U.S. Treasury is less trusted because we've got too much debt and we weaponized it in 2022. And we've created now a multi-dysfunctional, multipolar, new abnormal where it's more every man for himself. And unlike 1971, China's a lot stronger than it was then. And the BRICS are a lot stronger. And these tariffs are not going to be as easy. So again, my long answer to a short question is the reason the dollar is falling isn't some clever idea from Besant. This is going beyond his control. I think he panicked just like Trump when those U.S. Treasury auctions failed. And I think they know that the real problem is that demand for the dollar in every area is less there. It's less there at the treasury auctions. It's less there in the oil trade. It's even going to be less there in these volatile markets. And I love the milkshake theory with Brent Johnson, but he underestimates how distrusted the U.S. Treasury is.
Despite gold's ascent to record highs, macro strategist Matthew Piepenburg maintains that the precious metal is merely in the opening phase of a more substantial bull market. Though he acknowledges the inevitability of corrections, possibly rivaling the severe 30% decline witnessed during the 2008 financial crisis, the 2008 financial crisis is a critical reference point for understanding gold's transformed market behavior. When Lehman Brothers collapsed in September 2008, gold prices fell dramatically to $692.50 per ounce, a one-third reduction from their peak. This decline, however, did not reflect a loss of confidence in gold's intrinsic value. Rather, it represented an urgent liquidity crisis in which investors were forced to sell their gold holdings to meet margin calls and generate cash for other financial obligations in a rapidly deteriorating market. Gold is now demonstrating remarkable strength during periods of market instability, rising in tandem with broader financial stress rather than declining. This reversal of historical patterns suggests a fundamental reassessment of gold's function within the global economic architecture. Let's get back to the interview.
The major drivers for gold is always the same. It's not that gold gets higher, it's that fiat money gets weaker. These beautiful ice cubes, the dollar, the euro, the peso, the yuan, the yuan, the ruble, whatever. As long as there's a debt crisis, goes back to my original statement, this monologue at the beginning, everything is a credit crisis, everything is a liquidity crisis. When we're at this much desperation, we have to reliquify. The only way to reliquify is to expand the money supply. The only way to do that is to debase the currency. So gold is only in the first chapters. It's only in the first chapters. That doesn't mean that gold doesn't go down or that only goes in a straight line. Many, like Heinrich Sieberg, who I spent time with in Cape Town, use the 2008 example. When we had a major market mean reversion, gold sold off 30%. People are still waiting for a pullback in gold when it hits all-time highs. What I'm arguing, again, this is me selling my book, is be careful of thinking 2008 is like 2025, because unlike 2008, today central banks are stacking gold. The BIS has made it a tier one asset. And as we just saw in this last market volatility last week, U.S. Treasuries fell and gold rose. That's my view that gold is the better strategic tier one asset. People have a hard time separating me and my gold bias from these facts. And no, I don't think gold only goes up, but the world is saving in gold for a reason. Central banks are stacking it for a reason. The COMEX is out of gold for a reason. Trade settlements are done in gold for a reason. Central banks have been selling treasuries net and buying gold for a reason. All these signs are here that gold is the new tier one asset. So in times of crisis, it will be a better safe haven. Retail investors are not buying. It's still less than 0.5% of financial allocations. Family offices, less than 1%. It's the big whales that are buying gold. The retail investors, even the smart quote unquote family offices, are still in their diversification model. They're still led by CIOs who come from the banking system, still think like the old way. But if we just got, if gold's only a 0.5% allocation and we get to a 40-year mean of 2%, that's a 4x demand increase. A 4x demand increase will increase the price. If gold gets to 5% or 6%, or like Switzerland, 10% of a small allocation, the gold price will rip. But again, only because the purchasing power of paper money is getting weaker. It's astounding to me that it's only the central banks and the big wigs and the big whales that see gold, and that so-called smart money is still going into risk managed returns and diversified bond and stock portfolios. But a lot of hedge fund managers I knew in New York who did long short equity or arbitrage or credits, they were always buying gold personally and storing it somewhere outside of their jurisdiction, even when they were selling stocks and bonds. So it's hard to know what the smart money is or the inside money is, but our clients in 90 countries certainly aren't stupid, and they've been looking at gold over Bitcoin for a number of reasons. Not to get into an anti-Bitcoin discussion, but gold will go up, secularly, because currencies have nowhere to go but down because of the debt crisis and liquidity crisis with which we started this conversation. What I do see with what's happening in our real economy is before we have bazooka money, which is the only tool the Fed really has to save its bond market, because the Fed's real mandate isn't employment and inflation, it's saving the bond market. The only solution we're going to have to the unloved IOU crisis and debt crisis and liquidity crisis is M2 money supply expansion and fiscal deficits and more printed money to solve it. And that will be inherently inflationary, David. But between now and then, if we have it puking in the markets and the NBR actually does its job and officially calls the recession, which I have argued is well in place and already here, I mean, recessions have a strong way of killing demand, and market mean reversions have a strong way of killing tax receipts and capital gains. So before we get the hyperinflationary or extremely inflationary endgame, we could have obvious disinflationary moments. Recessions are disinflationary. Higher for longer rate hikes that Powell tried to win the war on inflation, which he lost, were disinflationary. So it's not an either or. It's a combination of cycles. You can have a disinflationary moment, but it will be solved with the only tools the Fed has left: bringing rates down and printing more money. And that to me is inevitable. Then, when that doesn't work, we're looking at probably some type of global dysfunctional reset in the introduction of CBDCs and more centralized control. And that's further down the road. We'll first go to the Powell handbook or the central bank handbook since Greenspan, which is just print more money to solve a debt crisis with more debt, monetized by money printed out of nowhere or mouse clicked out of nowhere. We're desperate. And then when that fails, and if we're not at war, hopefully, we'll come to some, Bretton Woods 2.0, as the IMF telegraphed, and like a classic psyop during the COVID man-made hysteria in 2020. It's just so obvious to me. And there is no solving a debt crisis without more mouse click money, which is inflationary. But again, I'll caveat by saying we could have a disinflationary moment in the meantime. If the markets tank further, or if we have a real brutal recession, tariff driven or not, in the US, that will be disinflationary.
The significant rise in central bank gold purchases underscores a shift in global financial strategies, driven by growing concerns over inflation, interest rates, and the overall stability of fiat currencies. As economic volatility continues, central banks increasingly turn to this precious metal as a reliable store of value, moving away from traditional assets like U.S. Treasuries. What do you think about the shift toward gold in today's economic landscape? Drop your thoughts in the comments below. If you found this video insightful, don't forget to like, share, and subscribe for more updates on the latest market trends. Thanks for watching.